Hello students, let us start today's session. In today's session, we are going to start a new chapter, new study note, which is regarding financial derivatives. In short form, we are going to say this chapter is of derivatives. So this is of derivatives chapter. Basically, in this chapter, it's a very students categorize this chapter as a complex chapter, as a tough chapter, but I do not find this chapter tough at all. It's a very easy chapter, and I'm sure maximum number of students will be able to understand this chapter easily and solve all the questions also easily. So it is not at all complex chapter, and let us start this chapter, financial derivatives. Now, what exactly we have to study in this chapter? Now, derivatives basically are your financial instruments. Basically, there are three types of contract. One is your forward contract. You must have heard these names in the Forex chapter if you have studied Forex chapter before. Forward contract. Another is your future contract. And third is your option contract. Now, these three types of contract helps you or protects you from the risk. So basically, these three types of contract are basically instruments to hedge or manage, whatever word you can say, hedge or manage the risk. So if you want to hedge, protect yourself from the risk, any kind of risk is basically implies what? Uncertainty. If you are unaware of future, you do not know what will happen and you want to be sure about future, you want to be certain about future, or you want the results to be certain of the future, then you can enter into any of such contract and make your future certain. So basically, these three financial contracts, they are contracts. There are proper contracts between two parties. Sometimes there are three parties also. So there are two. There are these forward, future, and option contracts are proper contracts which are entered between two parties to ensure that you are protected from the risk. So can I say these are instruments for risk management? Whole SFM is taught to you basically for what? In whole SFM, if you have studied the portfolio chapter, basically you have studied risk. Now we are learning how to manage risk through these three types of contract. Now what are we going to study in this chapter about these three types of contract? So first I will discuss only about the forward contract and future contract, and in the second part of this derivative chapter, I will categorize in two parts, part 1 and part 2. In part 1, I will be discussing forward contract and future contract. In part 2, I will be discussing all about option contracts. So forward and future contracts will simultaneously go on in the concepts. So let us talk about the part 1 of the derivative chapter. What are we all going to learn in this portion? So in the part 1 of forward and future contracts, we are going to learn lots of things like the meaning of these types of contracts. So we are going to understand basically the features and meaning of these types of contract. So understand the definition and meanings and features, basically a little bit of theory portion. So forward contract and future contract. Okay. Then the second practical. Now this is a very practical oriented chapter. Okay. So second is very interesting concept. That is very, very interesting concept. Pricing of futures or forward contract. So now pricing will have around, I think, 5 cases. there will be 5 cases under which we are going to learn how we price the future contract. So first of all, we have to understand what is future contract, what is forward contract, difference between the future contract and forward contract, and then the pricing. Okay. Then the third most important concept where students get stuck and unable to understand is index future contracts. We will understand the functioning of index future contracts. Then we will use this contract in hedging. So hedging through index future contracts. Then again there will be cases in this. Then the next concept we are going to understand is altering of risk in portfolio using index futures. So this all we have to learn regarding forward contract and future contract. Then there is going to be, I told you there are 2 parts, part 1 and part 2. In part 1 we are going to study forward contract, future contract, as well as we are going to study very important after immediately after solving the forward and future, after understanding the forward and future contract, very important concepts we will start, that is swaps, that is interest rate swap concept. Then we are going to study in this concept only your interest rate, that is caps, collar concept, then your floor concept. Then we are going to study in this concept only FRA, forward rate agreement. This is called forward rate agreement. So basically we are going to study these 3 concepts also in the part 1 only. So I can write here also, after studying regarding the forward and future, the second, let me say this is the part 1 A part, and then part 1 only, but the B part of it, that is your let me write like this, interest rate risk management using forward and future contracts. So here we are going to study what? Swaps, that is interest rate swap. Very interesting concept, everybody understands. I'll explain you in a very simple way. Then there are simple concepts are there, caps concept, floor concept, and then there is a collar concept. Then very important concept, FRA concept, you can expect a question from it, forward rate agreement. So these concepts will come. These concepts we consider in the concept of OTC derivatives. OTC derivatives are basically over the counter derivatives. I'll explain you when the time comes, over the counter derivatives. So this is all about the introduction, or rather I would say this is all about the index, what we are going to study in the part 1 of the derivatives. And part 2 is very normal options, and there are many concepts under the option heading also. So we are going to start with the part 1, forward future contract. I have taught the forward and future contract, option contract in Forex chapter also, but I am ignoring all that what you have learned in Forex. We have to restart learning this concept again in derivative. It is the same contract that you have learned in Forex chapter, but still I am going to re-explain everything from the starting. Okay, assuming you have not studied this concept or these types of contracts in your Forex chapter. So let us start with the forward and future contract. Okay. Let us start the part 1 portion. Now first question that we should be able to answer is, what is forward contract? What is forward contract and what is spot market? What is spot market or cash market? And the difference between the two. So if suppose for example I want to buy a book. today is, let us say, 1st March, and I want to buy a book. So what will I do? I'll go to a bookstore and buy the book. Suppose today's price is, let us say, rupees 125. So if I want to buy a book today, I'll go to the bookstore and I will purchase the book. I'll pay the money and take the book. So with the bookstore, I'm having a contract today. The contract is executed today itself, and this type of transaction where the settlement is done immediately, book is coming into my hand and money is going to in the hand of the other party, such a transaction where the settlement is done immediately, that kind of transaction is called transaction or deal is done in cash market. Now cash market here implies, or we can say, spot market. Now in the spot market, the settlement is done immediately. Settlement done immediately. At what price? The price prevailing. Settlement is done immediately. At what price? Question is, at what price? So answer is currently prevailing price. Now whatever the price is prevailing currently prevailing price, that price is called spot price. It's a spot market. It's a cash market. It's a spot market. Settlement is done today. I want to buy a book. I go to a market. I buy the book and settlement is done. Now suppose I want to buy a book. Instead of buying it today, I have entered into an agreement with the bookstore that I will buy this book after 1 month. Now if I am entering into a contract with the bookstore, please listen to this very carefully. Okay, I want to buy a book. Today is 1st March. On 1st March, if I agree to buy the book after 1 month, and I and bookstore decide a price at rupees, let us say, 130 after 1 month, now this contract is called forward contract. Now let us talk about the features. First feature, there are 2 parties. One is myself and another party is the bookstore. There is a commodity that we are going to buy and sell. I am going to buy a book and the other party is going to sell the book. So basically there is a buying and selling of some commodity. Okay. Third, the price is decided in advance. So price is pre-decided. Now the settlement is not taking place immediately. We are going to wait till 1 month. After 1 month, the price and the book will exchange hands. I will pay the price and I will receive the book at the pre-decided rate, which is 130. Whatever the rate is prevailing on that day, that is not relevant, it is irrelevant. So this type of contract where the execution is taking at the pre-decided rate, that is called forward contract. So in this contract, after 1 month, irrespective of the price of book, 1 month later, I will have to buy it at rupees 130 and bookstore has to sell it for rupees 130. So we are going to ignore the price which is prevailing on after 1 month. So irrespective of the price of the book price can be anything, 128, 132, but we are going to settle this whole transaction at the pre-decided rate, agreed rate, that is 130. Now this type of contract is called forward contract. So what is a forward contract? It is an agreement between 2 parties where one party is going to buy the commodity, other party is going to sell the commodity. Commodity can be anything. What do I mean here? The commodity can be anything. In this example, the commodity was book. You can even do the agreement to buy and sell the stock of any company, the shares of any company. You can also enter into an agreement to buy gold or silver or any kind of metal, or you can buy anything. Let us say you can buy let us say agricultural product also. So anything which is saleable, for that forward contract can be entered into. Okay, so forward contract can be entered for your stock, gold, or even currencies. Don't forget, in forex we have learned about the forward contract related to currencies. You can enter into contract to buy dollars or buy yen or any currency. So you can buy anything which is saleable in the market. You can enter into contract to buy or sell whatever position you want to take. So basically there are two parties who agree today to buy and to sell a commodity in future. They're going to buy or sell a commodity in future at an agreed price. This is called what? Forward contract. Now this contract is unique. Now let me talk about the features. Okay, this contract is unique. Why it is unique? Because there are only two parties and they are deciding about the quantity in which they have to purchase. They are deciding at what date they are going to purchase or sell. 1 month later, 2 months later, 3 months later, the price is decided by them. So it's a unique contract. Secondly, it is not exchange traded. That is, you cannot enter this contract through an exchange market. So it is not exchange traded. Why I have mentioned this? Because when we are going to study the future contract, that is exchange traded. So there is no exchange market in this involved. There are two parties, they talk to each other and they enter into a contract. There is no premium payable. No premium, no security is payable by any party. No security is payable by any party. Both parties just agree, enter into a contract. Now both parties are obligated to perform their promise, on date of maturity. Okay, so basically there is no premium payable, no security deposit is to be payable. So since there is no third party involved and there is no security, margin money, nothing is payable, so both party, any party can make a default also. Meaning what? Suppose since I have agreed with the bookstore, suppose this is a bookstore and this is myself, and today is, let us say, 1st March. On 1st March I have agreed to buy book at rupees 130 after 1 month. Now after 1 month, bookstore has to sell at the book at rupees 130, irrespective of the price prevailing at that day. Now it is a possibility that on 1st April, that is date of settlement, date of maturity, date of settlement, whatever the name you can call it, on 1st of April, it is a possibility that actual price of book, let us say, is rupees 135. Now bookstore is very unhappy. Why bookstore is unhappy? Bookstore party is unhappy because they are obligated to sell me the book on 1st of April at 130 because we have entered into an agreement, and or in the market the book is selling at 135, so they are not gaining much by selling the book to me at an agreed price. This agreed price is called forward price. This agreed price, my dear students, is called forward price. So this agreed price, selling the book at the agreed price, bookstore is not happy because in market the spot rate, the rate prevailing on that day is 135. So bookstore is not at all happy. So there is a possibility that bookstore refuses to sell book to me. Now what will happen? Since this contract is not exchange traded, there is no security deposit you have taken from the other party, there is no premium payable, no margin money has been kept. So if bookstore refuses to sell you the book and this does not fulfill this contract, then there is only one option available, that I can go to the court of law. I can go to court of law and enforce this contract. So basically only one remedy is available to me, and that is I have to go to court of law. Otherwise, if I do not go to court of law, then this contract remains breached. So if there is a breach of contract, only one remedy is there, that is you have to go to court of law. So many people do not go to court of law because nobody has so much of time to waste. Hence, this contract has one problem, that is this contract has one biggest problem, that is the risk of default. This contract is not made in such a way, the negative aspect of this contract is anybody can make a default, and only one remedy is available, that is you have to go to court of law, which many people avoid going. So there is a risk of default in the forward contract, which will be cured. This negative aspect will be cured, removed in the second type of contract, that is your future contract. So future contract is much more advanced than forward contract. And one more negative feature of this contract is, forward contract is, both the parties have to remain in this contract for 1 month. Since this contract's period is 1 month, so both parties cannot transfer their right or obligation to third party. In this contract, let me show it on the next page. In this contract, neither myself, neither the bookstore, see, we both have rights and obligations in this contract. We both have rights and obligations. Obligation is for, if you talk about myself, I have an obligation to pay rupees 130, and I have a right to buy. I have a right to buy book at 130. So I have a right also and I have an obligation also. Similarly, the bookstore has a right to sell at 130 and has an obligation also to sell at 130. Now both the parties have their rights and obligations. Now they cannot, rights and obligation. Now they cannot transfer, both the parties cannot transfer their right or obligation to third party, Similarly with me also, I cannot transfer my rights or obligation. That means I cannot ask any other person to buy the book on my behalf. I have to fulfill this set of promise. Whatever promise I have made in this contract, I have to fulfill. Whatever the promise bookstore has made, that he has to fulfill. We both cannot transfer our right to somebody else. So we cannot transfer our rights and obligations. So there is a problem of illiquidness. That is, if I want to get free from this contract before 1 month. See, we entered this contract on 1st of March. And this contract is to mature on 1st of April, when we are going to physically take the book and give the money. Now I want to leave this contract in the midway. I cannot do so. I cannot transfer my rights or obligation to any other party. I have to wait till the maturity and execute this contract. So I cannot run away from this contract in between. So this is an illiquid type of contract. This negative feature is also cured or removed in the future contract. Provides a solution for this. Future contract provides a solution for such a problem. So now what you have to memorize, this much is only about the forward contract features. Okay, now what you have to finally memorize regarding the forward contract. The forward contract is between two parties. First of all, forward contract is a unique contract. The quantity, how much you have to buy or sell, the commodity, the price is decided by two parties only. There is no third party. It is not an exchange traded. You cannot buy or sell on the stock market exchange. You cannot enter into this contract through an exchange. There is a proper derivative exchange market like stock market. So it is not an exchange traded contract. There is no premium securities payable on this contract. You just enter into this contract, and in this contract there is always a risk of default, and only one remedy is possible, that is you have to go to court of law if any party does not fulfill its set of promises. And the last negative aspect is you cannot transfer your right or obligation to third party. You yourself have to fulfill your set of promises. So it is an illiquid asset in that form, and all these negative aspects will be cured by the future contract. So this is all about the forward contract. Please write down a small definition of forward contract. A small definition of forward contract. Forward contract a forward contract is an agreement entered today under which one party agrees to buy and other agrees to sell a specified asset on a specified future date at an agreed price. Features: first is uniqueness, unique. Second is performance, obligation. You are obligated to perform your promise, fulfill your promise. Price risk is eliminated. This is very important. I'll explain you what this means. Price risk eliminated. No premiums, no security deposits, no margins. Default risk is always there, and it is illiquid. Not exchange traded. Please write it down. What is the price risk eliminated? Write it down. Yes, price risk is eliminated. Yes, definitely. Since in the example I have agreed to buy the book after 1 month, the book I need, which I am going to buy after 1 month, and the price is decided 130. Now whatever the price is on after 1 month, irrespective of that, prices can go down also, prices can go up also. Irrespective of that, at least my price is now certain. I know I can get this book at 130. What may be the price? Prices can go low also, and it can go high also. But the price, what is the risk? Uncertainty. Uncertainty is removed, completely eliminated, because your price is now certain. Definitely there can be a gain or loss with the fluctuation of prices. Now why? Very important question comes. Why this forward contract is called derivative? Why this forward contract is called derivative? Because derivative implies please write down the definition of derivatives first, then I will explain you the meaning of derivatives. Write down the definition of derivatives. Yes. A derivative contract is a financial instrument whose payoff structure is derived from the value of underlying asset. Yes. Now, why forward contract? In short form, we write FWD. Forward contract is called derivatives. Why this name is given? Very simple. Now, in our example, I was supposed to buy on 1st of March. We have entered into a forward contract in which I am going to buy a book, and the price decided is 130. Buy book after 1 month, and the price decided is 130. This price is called what price? Forward price, don't forget. And the other party is your bookstore. Now in this contract, please observe, after 1 month, that is on 1st of April, the price in the market, that is spot price, can be anything of the book. The spot price can be anything. Let us take some examples. The spot price can be either above 130 or below 130. It can be, let us say, 125 or let us say 135 or 130. Now, who is going to gain and who is going to lose? Let us see. This is myself and this is bookstore. And then we'll justify the why forward contract is called your derivatives. Now see, what will happen? How will we gain or lose on this contract? And how is risk eliminated? Please observe. See, these are just basic things, but we have to grow basic from the basics. So I'm teaching first basic things, normal, very small basics. Then within, you will see within few minutes, the things are going to get complex. Okay, so just wait and observe. Now see, why forward contract is called derivatives. Now in the definition of derivative, it is written, a derivative contract is a financial instrument whose payoff structure is derived from the value of underlying asset. Now in this contract, the asset is book. In this contract, the asset is book. This is the underlying asset. Now I am going to physically buy the book and pay 130 price. Suppose on 1st of April, on the date of maturity date, I'll buy the book at 130. Now when I see the spot price on 1st April, the spot price is 125, and I am sad because I had to purchase the book at 130. I am losing how much rupees? 5 rupees. Otherwise, if this contract was not there, I would have purchased the book at 125, but I am obligated to purchase the book at 130. So I have to buy at 130. I will buy the book at 130, but I am losing 5 rupees because the price in the market is 5 rupees, 125. And bookstore person is very happy because he has a right to sell the book to me at 130, even though the market price, the spot price is 125. So he is gaining rupees 5. Now this gain or loss is called payoff. Now we are gaining or losing because of the value of the asset. Now in our example, the asset is the book and this 125 is the value. So basically, can I say like this? our payoff, this is our payoff, we are gaining or losing. Our payoff is dependent on the value of the asset. This price is the forward price, but our gain or loss depends upon the spot rate in the market or the market price of the asset. Okay, let us observe again. For example, this is case 1, right? Let us take case 2. Suppose in the market the price on 1st April, the book price is 135. Now I have to buy the book at 130. But I am very happy. Why? Because in the market on the date of maturity, the price of the book is 135 and I have the right to buy at 130 because of the forward contract which I entered on 1st of March. So I'll buy the book happily at 130 even though in the market the book is selling it for 135. So I am basically gaining 5 rupees and bookstore is losing 5 rupees because he is obligated. See how I am using the word right and obligated. When somebody is gaining, I am using the word right. When somebody is losing, I am saying he is obligated to perform. So bookstore is obligated to sell me the book at 130 even though the market price is 135. So our price is certain 130, but we are gaining or losing on this way, on this basis because of the value of the asset. This is the value of the asset in the market, because of which our payoff. So that is why these contracts are derivatives, because these under these contracts, these financial instruments, in our example, the financial instrument is forward contract, whose payoff structure, our payoff structure, gain or loss, is derived from the value of the underlying asset. That is why these contracts are called derivatives. So now I want, till this stage of the lecture, I want my students to understand only 3 things. 1, just say yes or no. Have you understood what is your spot market is? The spot market, or we can say the settlement, the settlement is done immediately. If you buy or sell on the same day, the deal that is called the deal is in the cash market or the spot market. We can use it interchangeably. Okay, so if I want to buy today, I go and buy, that is called, we are dealing in the cash market. I go and buy, we do the settlement immediately. But when we enter into a contract to buy in the future, that is called forward contract. Okay, second thing I want you to know, that the price which is decided for future in the forward contract is called forward price. Okay, or future price. Okay, so this is the price. Now whatever the irrespective of the price in the future, this is your decided price, this is your forward price. Okay, so whatever is the price in the future, spot price in the future, that is that at that rate you are not going to deal, you have to buy or sell at this rate. And the third part is, in the forward contract, you physically take the commodity, you buy the commodity and you sell the commodity and exchange the money also. So this is all about the forward contract. Now after understanding what is forward contract, now the next stage is to understand the pricing of forward contract. Pricing of forward contract, and for the next 2 lectures I am going to use forward contract and future contract interchangeably. I am going to use these words forward and future contract interchangeably for the next 2 lectures, even though both the contracts have various differentiations, but still we are going to use these 2 contracts interchangeably, because the pricing rules apply same for forward contract as well as future contract. So basically we are going to learn the concept, the pricing of forward contracts, and sometimes I will call it as a future contract, because both contracts are quite similar, except that this contract is exchange traded. We are going to learn the mechanism also, but predominantly this contract is exchange traded. This contract gives you the liquidity feature. This contract does not have the default, risk of default, no risk of default is there. So these are the quite good features of future contract, and its mechanism is a bit different. Settlement by cash, not by delivery, maximum times. So we will understand future contract, but sometimes interchangeably I will be calling forward contract as future contract. Okay. Now the concept that we are going to start is the pricing of forward contract. Now what are we going to study in this? In our forward contract, suppose there are two parties, party A and party B. There are two parties, and party A on, let us say, 1st March decides to buy 100 shares of Reliance company from B after 1 month, and now the price will be decided. Now the question is, when this forward contract is being entered, obviously it is a forward contract because it is an agreement to buy and sell an underlying asset in future after 1 month at an agreed price. Now how is this price agreed? What is this price going to be? That we have to learn. What is going to be the price between the forward contract? That we have to learn. Pricing of the forward contract. Is there any parameters that are followed before deciding the price between the two parties buying and selling? So that is the concept, pricing of the forward contract. And then two words will emerge: theoretical / fair price and actual market price. So we will talk about this also. Actual forward price, I would say, instead of market price, let me write as forward price. Actual forward price. So this is the topic that we are going to discuss. Now before proceeding to study this concept, there will be 5 cases, let me tell you. But before starting these 5 cases, we have to study some principles or some rules of valuations. Some rules of valuation we have to learn. Valuation here means pricing of forward contract, and you know what I mean by pricing of forward contract. That is how the agreed price is decided upon. What will be the agreed price, basically? What will be the agreed price between the two parties under forward contract? That is the question. So before starting learning this concept, we have to do the rules of valuation. Now the first rule that we have to learn is compounding. Ma'am, we very well know what is compounding. We have learned compounding in the section A, capital budgeting also. And so compounding we know. No, you do not know the compounding. You only know annual compounding or quarterly compounding or monthly compounding, right? But in this chapter, we are going to learn continuous compounding. So this is one aspect that we have to learn, on which we are going to dedicate some time. And then the second concept that we have to learn before starting this pricing of forward contract is short selling. What is short selling concept? So let us start learning these rules of valuation, and then we will go on to the pricing of forward contract. Now let us start from what is compounding. Compounding means how frequently interest is given. How frequently interest is given. Interest is offered on investment, right? Now if we say compounding is to be done annually, what does this mean? Let us take an example. If we say that the compounding is annually at 10% interest per annum on rupees 1,000, let us say, for 1 year. So basically we have invested money for 1 year. So on rupees 1,000, the interest will be paid after 1 year. Interest will accumulate after 1 year. So during what will be the interest on 1,000? 1,000 you will receive, plus on 1,000 you will get 10% interest rate, right? So if you take 1,000 common, what is left in the bracket? 1 plus 0.10, right? Now if this investment is for 2 years, you have to multiply here by 2. This you know very well. If this investment is for 2 years, but currently the investment is for 1 year. Okay. So how much is this coming? This is going to come out to be how much? Rupees 1000 plus, let me write here, 1.10 into 1000. So it is coming out to be 1100, right? So this is your amount that you will get after 1 year. Now I want to create a formula. How can I create a formula? What is this 1100? This is the amount that you will receive after 1 year. How did you compute this 1100 rupees? This was your initial investment. So this is your principal, which we call principal P. The amount to be compounded, principal. 1 plus the rate of interest, right? So basically the formula is A is equal to P 1 plus R, which you have learned in your school days. Now this amount, let me write it in our FM language. Now this A represents the amount that you will be receiving after 1 year. So can I write this is future value? And this P is the investment that you are doing today. So this is present value, 1 plus R, right? This is the formula. So if you want to find out how much you will get in future, so whatever you're presently investing into 1 plus R. And here we write N because if the investment is for 2 years, then the N represents number of years. So this was normal compounding, annual compounding. Annual compounding here means that the interest accumulates after 1 year. Now if I say, let us do semi-annually. Now you will understand the difference. Semi-annually if we say, so let us proceed further on the same question. Example, let us compute, let us do the compound, let us compute amount receivable if compounding semi-annually at the rate of 10% per annum on rupees 1000 for 1 year. Now let us see, if the compounding is done semi-annually, how much will you receive, because the investment is for 1 year, right, on 1000 rupees and the interest rate is 10%. So R is your 10%. Your present value or your principal is your rupees 1000, and your the number of years you have to make an investment is 1 year. Now let us see, on 1000 rupees, since the compounding is semi-annually, that means the interest will come half yearly. Semi-annually, that what I have just told you. What is compounding? Compounding implies how frequently interest is offered on the investment. So now when we are saying that the compounding is semi-annually, interest will be received semi-annually. So let us compute semi-annually means half yearly. So let us compute the interest half yearly. So on 1000 you will receive 1000 plus on 1000 you will receive interest semi-annually, which is coming out to be how much? 10% is the interest rate for 1% for full year. So half year it will be how much? Let me divide by 2. So you will be getting how much? Let us write like this, 1000 into rupees 1000 into 5%. Let me take 1000 common. So I am left with 0.05. I have divided it by 2. Why? Because the interest rate is per annum and I just want to compute the interest rate for half yearly. So I have deduced it to half yearly percentage and this is coming 5%. So how much is this? I want you to observe something. 1000 into 1.05, which is coming out to be rupees 1050. Now this amount of 1000 will become 1050 in half year. Then the next half year, again interest will accrue because your compounding is semi-annually. I know you know all this thing. Still listen to what I am trying to say. Now you will observe something. Now on 1050 rupees, since the investment is for 1 year, so I have not withdrawn any money, I will be getting interest on this amount now. So in the next 6 months interest will be on. Now this is my principal. On this amount I will receive 1050 all plus principal I will receive plus interest on this amount at the rate of 5% half yearly. So 1050 bracket 1 plus 0.05. So how much is this coming? 1.05 into This is coming 1102.5. Now I want you to observe something. What is the interest rate? 10%. But end of the day, please observe. I know you know this process. You know, for the first half year, 5% interest is accrue. Then on that principal and interest total, you will get again interest. I know you know this thing. Now after 1 year, how much you are getting? You are getting 1102.5. Earlier, you were getting how much? With the same 10% interest, if annual compounding was done, you were getting 1100 only. Now you are getting 1102.5. So now let me check something. Let me check the effective annual rate. This is what I want to tell you. Effective annual rate. How much is the earning in percentage, in the terms of percentage? Now I am getting 1102.5. My investment was 1000 initially. So let me see how much I am getting as an interest. I am getting interest 102.5 rupees. Let me check in the terms of percentage. So 102.5 rupees I earn as an interest when I make an investment of 1000. So how much is my rate of return? My rate of return is 10.25%. So this 10.25% is called EAR, effective annual rate, which can be asked in your exam in multiple choice question also. Okay, so coming back, this is effective annual rate. Even though in the question it was written that the interest rate you are earning is 10% per annum, but effectively you are earning 10.25% when the interest compounding is done semi-annually. So the more frequently you get interest on your money, your effective annual rate increases. Okay, now the next thing, let us create a formula from here. Okay, you got this figure. From here. Can I write 10? Let me write on the next page. This is your 1050 into 1 plus 0.05, which was coming out to be 1102.5, right? This is amount, right? Now 1050, can I write, instead of 1050, can I write like this? 1000 into 1 plus 0.05? Okay. So can I write like this? Rupees 1000 into 1 plus 0.05, 1 plus 0.05, right? So this is the amount coming. Now rupees 1000 into 1 plus 0.05 square. Now can I write like this also? Is it possible? 1 plus 10%, it was the interest rate, which I divided by 2 to make it 5% because I was getting interest half yearly, and 2, right? Now what is this 2? Did you invest your money for 2 years? No. This 2 represents here number of times compounding. Please listen to this very carefully. Number of times compounding done in a year. In a year, how many times you have done compounding? How many times you are going to get interest? Since you're in this example, the interest was compounded semi-annually. That means half yearly you will get interest, then half yearly. So number of times in a year, how many times you're getting interest? Twice, right? So 2. So this represents, let us denote, give it a variable m equal to 2. So the formula now is, this 1000 represents your present value that you are investing into 1 plus rate of interest divided by m into m. And since number of years investment is only 1 year, so otherwise you should multiply with the n also. N represents number of years. So the final formula now you have to follow is the present value into 1 plus r divided by m. M represents number of times you are going to do the compounding. Bracket close, m into n. Now for example, let us say on the same example, now let us do quarterly compounding. Quarterly compounding at the rate of 10% per annum on rupees 1000 for 1 year only. So let us compute. Now let's use the formula. Formula is what? Present value into 1 plus r upon m n into m. Let us find out the amount or the future value. So your investment is 1000 into 1 plus r. Our rate of interest is how much? 10%. Now you are going to do compounding quarterly. After every 3 months, interest will accumulate. So after 3 months, that means in a year, just in 1 year, how many times you will get interest? I just want to know the in 1 year. Even though if you do the investment for 5 years, still M represents, this is also one of the mistakes students do. M here represents number of times you are doing compounding in a year. In a year, you are doing compounding how many times? Let me show you. In quarterly, in a year, how many times you will get interest? 4 times. So M here represents 4. So I'm going to divide by 4, multiply here by 4, M. And since the investment is only for 1 year, so N. So how much am I getting here? Let me calculate. 0.10 divided by 4 plus 1. So 1.025. So we are going to get 1103.81. 1103.81. So this is the amount that we are going to get, future value you can say, or the amount you're going to get. So now suppose in the same example, if investment is for 2 years, then what will be the amount? Same formula. In a 1 year, how many times compounding is done? 4 times. So only for 1 year you have to show 4, and then the number of years investment 2. So please, it is automatically becoming 8 times, right? 8 quarters will become. So you don't have to do anything. You just M represents, basically you have just don't forget M represents number of times compounding done in a year. That's it. Okay, so whatever the figure will come, that is the amount. Okay, so we have understood this thing, that compounding, and we have also understood that the rate of interest might be 10%, but effectively we are earning more the moment the compounding is done more. That is, if the frequency of interest, receiving interest becomes higher, we get effectively annual rate of interest is also becoming higher. Okay, so we have understood this thing. Just a second. So we have understood that compounding can be annually, compounding can be semi-annually, compounding can be quarterly, compounding can be monthly. In the case of monthly, that represents every month you will get interest. So in a year you will get 12 times interest. So M is 12. Your compounding can be daily also. That is, every day your interest will accumulate. So M here becomes how much? 365. And you can even do compounding continuous basis. Now what is continuous basis? That your interest keeps on accruing. Keeps on interest, you continuously gets on getting the interest. So continuous compounding. Now in this case, you have to do exponentially, since your interest is growing exponentially. Now the exponential rate will come into the picture, since you are doing compounding continuously. Now if for these types of compounding, your formula was what? Whatever your present value of the money was, into 1 plus r upon m into n. You used to get future value. Now in the same formula, the changes will be done for the continuous compounding, because continuous compounding will be used in our derivative chapter. What changes will be done? This portion will be changed. Very simple. present value into e raised to power rt is equal to future value. Now this represents your continuous compounding factor. So now how are we going to solve this? Now what is this R? R is the rate of interest, and T represents the number of years you're going to make the investment. So time for investment. Now where is this E? How we are going to solve e raised to power RT? Now in our book, so basically what we are going to do, R represents the rate. See, now this is continuous compounding. So there is no, as such, there is no M into it, because now continuously your interest is going to get accumulated. You're going to earn interest on interest on interest. The moment we are getting exponential interest on our interest. So for whatever amount of investment, whatever the time period you are going to do the investment, 1 year, 2 year, 3 year, continuously your amount interest will keep on accruing. Okay. So now this is exponential. By exponential rate, your interest is growing. So R represents the rate of interest and T represents the time of your investment, which has to be represented in years. So basically, suppose let us say you are going to invest in let's say 742 days or anything. You have to show here the time in years, 1.5 years, 2 years. The figure has to be shown in years. Okay. Now, where we will get the value of this? Suppose after putting this value, it is coming e raised to power 0.02. Suppose. So now from where we will get this value, you have to see our book. In our book, let's see in our book, in our study material. In our study material, you will find in the end of our study material, there are various tables given, PVF table, PVAF table, and the same tables in our book on this is given A.81 table. Now this is the table which is on natural logs, e raised to power x and e raised to power minus x. I will show that, I will explain you that also. So e raised to power x is here, right? Now these figures represents the value of x. Now what is the value of x in our example? E raised to power, I have just written 0.02. So 0.02 is the x. That's its value is 1.0202. So I will use this value 1.0202. Go back to my solution and put it here. How much it was? 1.0202. So I will get my future value. Whatever my present value is, I will get that. So whatever here, after multiplying R with the T, whatever the value is coming, we have to locate it into the table and then write the amount, and then we will find the figure. Here in this example, I have directly written 0.02. Okay, I'll change this figure also, but I want to tell you something more. See, now we have understood that in the continuous compounding, if you want to find out the future value of your investment, you just have to multiply it with e raised to power RT. Now if I want to find out the present value and future value is given, so what do I have to do? I have to take this figure to RHS side. It will become like this. So future value into e raised to power minus RT, it will become, if I take it on the numerator. So now what I am doing, I am trying to find out the present value if future value is given. When you want to find out the present value, it is called discounting. So basically you are doing what? You are doing continuous discounting. So discounting implies you are finding present value. Compounding implies you are finding future value. So don't forget, when we say discounting, basically what we are trying to do, future, we are trying to find out the present value of the future value by discounting it continuously minus ERT. And I told you that table has the values of e raised to power RT also, e raised to power minus RT also. Okay, this RT is shown as X in the table, minus X. So this is about discounting and continuous compounding. Now we have to learn a simple technique of interpolation. Interpolation to find out the value of e raised to power RT. That let me explain you, because in the whole chapter of derivatives we have to continuously find out the value of e raised to power RT. So that should be very much clear in your head. So let me explain you how to find properly the value of e raised to power RT. Now let us take an example of continuous compounding and let us use the interpolation technique. Okay, so the example is, let us say find future value of rupees 1000 continuous compounding at the rate of, let's say, 7% per annum for half yearly. So investment is for half yearly. Okay, now let us find out the future value of 1000 at the rate of 7% per annum for half yearly. Now we want to find out it is a continuous compounding. We want to find out the future value and the present value is given. So we have to multiply with e raised to power RT, right? Now what is R in this picture? R is the rate of interest per annum, that is 0.07. Okay, what is time T? Time of investment or time for investment expressed in years. So expressed in years, how will you express in years? Now the investment you are going to make for half yearly. So half yearly can be represented in years as how much? 0.5 years. Not 1 year, 0.5 years. So now present value is how much? 1000 into e raised to power 0.07 into 0.5 half yearly. So now let us find out the value 1000 into e raised to power. How much is this coming on the calculator? 0.07 into 0.5 is coming out to be 0.035. Now what is the problem? Let us go to the table and find out the value of this. Now we know in the table e raised to power x is given. Now in our example, x represents what? 0.035. Now let us check, is there any such value given in the table? Let us see. Don't forget e is raised to power 0.035. So let's see in the table. Now this is your table of your e raised to power x continuous compounding. Now x is given, 0.03 is given, 0.4 is given, but 0 up to 2 decimals it is given, but not up to 3 decimal. But we know very well that our figure 0.035 lies between 0.03 and 0.04. So let us do one thing. Let us take the value of 0.03 e raised to power x, this figure, and 0.04 e raised to power x, this figure. These two figures we will take up because we know our figure lies between these two figures. So let me write these figures on my sheet. It is e raised to power 0.03 figure is given how much? 1.0305, and e raised to power 0.04 is given how much? 1.0408. So I have written, let us go back to our solution. Yes, so I have already written this thing. Now we know we have written the figures of e raised to power 0.03 also and 0.04 also. Now we want to find out the value of e raised to power 0.035. This figures lies between 0.035 figures lies between these two figures. This is our target. Now observe interpolation technique, or you can say unitary method. When you increase the value of e from 0.03 to 0.04, the difference is 0.04 minus 0.03, the difference is 0.01. When the x value difference increases by 0.01, the value changes from this figure to this figure, how much is the value changing? 1.0408 minus 1.0305. It is coming out to be how much? It is coming out to be 0.0103. So can I say like this? When the e raised to power 0.03 changes and increases to 0.04, that is, it changes by 0.01, the final answer changes to this, by this amount, right? It changes by this amount. Now, do I want the e raised to power this figure to change to this, or I just want this much of change? My change is that e raised to power 0.03 should become e raised to power 0.035, and I get the value of this figure. So how much is my desired change? Now the difference between these figures is it how much? 0.005. If you subtract 0.035 by 0.03, you get this much. So can I find out how much will be the change here? Let me speak again. See, when you change the e raised to power 0.03 to 0.04, your final answer changes to this figure. I just want to know, if I change the value from 0.03 to 0.035, how much is the change? How much is the change from 1.0305 to this figure, so that I get the value of e raised to power 0.035. So what do? Simple unitary method. When I change this value by 0.01, okay, e raised to power x, I change the 0.03 to 0.04, the change is 0.01, then the final answers also changes by this amount. I do not want to change this figure to this figure. I just want, this is my desired change. How much change I want? 0.005. Then what will be the change here? Very simple unitary method. Again, let me repeat. When I change the value of x from 0.03 to 0.04, the final figure changes by this amount, right? So when I change the figure, this amount changes. Now I just want the e raised to power 0.03 to change to e raised to power 0.035. The difference is this much. If I change the difference x value by this much, how much will be the change in this figure? How much will be the change in this figure? Now when we solve this figure, we get, just a second, 0.0103 into point divided by, yes, so we are getting 0.00515. Ma'am, is this the answer? No, this is not the answer. This is the change that will happen in this figure. So the final answer is, I'm writing here, e raised to power 0.035 answer is the change that will happen in this figure, 1.0305 plus 0.00515. So 1.0305, it becomes 1.03565. I hope it is visible. So now so basically we have found this figure. Now we can put this figure here and we can find out the future value in the next page. So future value is, we were supposed to multiply 1000 with e raised to power 0.035. Now we have found the answer. So it is 1.03565. So we multiply by 1000, we are getting 1035.65. This is the future value. So if you invest 1000 rupees at the rate of 7% for half year only, continuous compounding, after half year you will get 1035 rupees continuous compounding. See, continuous compounding gives you such a higher rate of interest because interest is accruing on regular continuous basis. So exponential rate of increase is there. Now, ma'am, you were saying derivative is very easy. This looks so clumsy. It is not at all clumsy. When continuously in whole chapter, we are going to just compute e raised to power, because in whole chapter we have to again find out present value, future value. Yes, time value of money has to be given importance. So now, but the difference is we are doing continuous compounding. In capital budgeting, we used to do annual compounding. So that is the difference only. Okay, so coming back to here calculation. Now this is e raised to power 0.03. Let me repeat once again. Whenever you have a 3-digit figure, that is e raised to power x, you have to locate 2-digit figures, one above, one less and one more. So this figure lies in between. Now then what you have to do, find the difference of the x, final difference values. So that this, when you change the x value by this amount, the final figure changes by this, but this is not the change we need. We just need this much change. So this much change is how much desired change? 0.05. You put a unitary method and then you find out, okay, this much change brings this much change, so this much change will bring how much change. Now and then add this figure to the main final figure, and then this is the answer. Okay, so we have understood the how to compute e raised to power x, and with practice with the questions we can compute further. Okay, so now this is all about your e raised to power x computation. We will face, if you face difficulties, don't worry, with every question we have to practice the same thing. So it will keep on coming again and again. Now let us do another concept, which is short selling. But before that, the kindly write it down, the whatever we have written just now. Then one concept is left, short selling. Then we can start the pricing of the forward contract. I'm putting up the sheets, you can write it down. Yes, this part began from here. We started with rules of valuation. Basically, we started the principles that we need to follow while doing the pricing of the forward contract. So we learned compounding, annual compounding, quarterly, monthly, where basically the M is changing. So please write it down. Pause the screen and write it down. I'm changing the sheet. Please write it down speedily. Just pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down. Pause the screen and write it down. I'm changing the sheet. I'm changing the sheet. I'm changing the sheet. Pause the screen and write it down, dear students. Pause the screen and write it down. And this was about the continuous compounding, how we do that. Pause the screen and write it down. Pause the screen and write it down. Okay. So now let us do the concept of short selling, which will be used in the pricing of forward contract. Very simple concept, but the word will be used. Now what is short selling? Now suppose let us assume you are into stock trading, you are into share trading. Okay, let us say you are into share trading. Now you basically do trading day-to-day basis, on the day-to-day basis. Okay, and in the share trading, what action will you take? I'm asking you. Suppose there is a company A whose shares are currently 70 rupees. Okay, currently they are at value of 70 rupees, and you are anticipating the values to go up to 100 rupees within, let us say, 3 days, or let us say within, let's say, within 1 month's time. Okay. So let me say like this. Within 1 month's time. Very small concept, please focus. There is a company A shares, currently they are trading at 70 rupees and you are anticipating that these share prices will go up to 100 rupees in 1 month time. So can we make a profit out of it? Yes, we can make a profit out of it. Very simple. You buy shares today. Keep it with you for 1 month, and after 1 month you sell the shares for 100. You buy it today for 70 and you sell it for 100 and you make a profit of rupees 30, provided your prediction goes correct, because you have predicted or anticipated, whatever word you use, you have predicted that the shares prices will go up to 100 rupees. If it doesn't go, then definitely you will make a loss. But if your prediction goes correct, you can make a profit of 30 rupees. So when you anticipate the share prices to go up, when you anticipate the market is going to be bullish means when you think the prices are going to rise, what do? You buy today and sell in future. You buy today and sell in future, because every smart person will sell at higher price and buy at lower price. So you sell later, okay, in future. Now again, this is not short trading, short selling. Short selling, I'm just telling. This is one case. Now another case. Suppose the same company A shares currently trading at 70 rupees. Okay. And you predict or you anticipate that market is going to be bearish. Bearish means that you think that prices are going to fall. Bearish, that is what it means. So you think that the company A shares prices are going to fall and fall to rupees 40. You are just anticipating. Now, first of all, let me tell you, you do not have any shares in your pocket. Okay, you have nothing in your pocket. You are just a empty pocket person. Now let us see what can you do here. Now, and you are anticipating this is going to happen within 1 month. So what are you going to do? Currently it is trading at 70, higher price, and in 1 month's time it is going to become 40. Can we make some profit in this scenario? See, there is no point buying today at 70 because it is costly. Why would somebody buy at 70 and then sell at 40? It is always better to sell at higher price. So if I sell today, one share of company A, I will get 70 rupees and I will become very happy. But the problem is I do not have shares in my pocket. How will I sell? So I call my broker and I ask my broker to lend me some shares. Of company A today. So I'm asking him to do the stock lending. Okay. And I am asking that please lend me some shares today of company A. I will return you back company A shares after 1 month. My broker agrees to this, obviously for some charges, but he agrees to me. Now what will happen? Since I have borrowed, you understand? I have borrowed the shares of company A. Now I have company A's shares in my pocket today. I will go to the stock market. I will sell those company A's share today and have 70 rupees and I will become happy. But after 1 month, when broker will call me that please return company A's shares, then there is no worry, because after 1 month, I will buy in the market. I will buy company A's share at the rate of rupees 40 and then I will return these shares to the broker. And since I have purchased the shares at only 40 and I have sold for 70, so I have pocketed how much profit? 30 rupees profit I have pocketed. If my anticipation goes correct, if my prediction goes correct, and still I have to purchase shares after 1 month because I have to return it to broker. So even if prices do not fall, it increases, If my prediction goes wrong, then even I have to make a loss, I still have to buy shares and return back to broker. But this process of taking the shares or borrowing the shares and then selling it today and then buying it later is called short selling. Short selling means sell today and buy in future. And why are you doing this? Because you anticipate or you predict that market is going to be bearish. Bearish means bear. Why bull and bearish words are used? Bull runs fast, so market value is going to increase, and bearish means bear which runs slowly, so that means the market is going to go downwards. So 70 price we expecting that it will fall down to 40. You can make a profit. You need to just borrow the shares from broker. Now, what is the benefit of the broker in this whole transaction? Broker here in this scenario charges stock lending charges. Very nominal amount, that is stock lending charges. It gives you shares of that company on a very it gives you the shares for a short span of time, and charges you because they have lended you the stock means shares, so they charge you something, but that is very less amount, more than what you are thinking you are going to make profit. So I hope you have understood short selling. Short selling means when you anticipate the market is going to be bearish. When you use such heavy words, you should also feel those words. Bearish means you are anticipating that market is going to go down. What do you mean by market is going to go down? Simply the share values are going to go down. When share values are going to go down, can we make some profit out of this scenario? I can make a profit out of scenario. I can sell today and buy later. Now, to sell today something, I should have that thing in my pocket. So I go to the broker and ask him that can you lend me some shares of company A? Broker will say, okay, you take the shares, return me after some time. I will sell these shares at 70. I'll make myself happy. After 1 month, I will buy the shares, whatever the price is. I hope the share prices are 40 and I make a profit and I return the broker the share. Broker gets his shares also back, and as well as some charges is his earnings to broker. So this is the course of action you take under short selling when the market is bearish, and when market is bullish, you buy today and you sell in the future. Okay, so this is not short selling. I was just trying to explain you the how to make the profit. Okay, short selling is the case number 2. So case number 2 is of short selling. Short selling is selling today and buying in future. Now let me make you write a note on the short selling concept. Please write down a note about short selling. This fundamental we will use, this mechanism or this course of action we will use in our pricing of future or forward contract. Short selling involves selling a stock which you don't own and buying it back later to square the position. This is done because you expect the price to fall and want to benefit from it. Example, suppose Trim Limited, there is a company Trim Limited is trading at rupees 700. You expect the price to fall to rupees 650 in a month's time, the only way to gain in a bearish market is to sell now, and if need be, buy later. But you do not have trim share. So what do you do? So your broker, basically your broker borrows the share on your behalf. Okay, but we say that we borrow the shares from broker. Basically the broker is doing the trading on your behalf. So your broker borrows shares on your behalf and sells them. This is called stock lending. You are required to pay stock lending charges and the stock lending charges, on the next page I am writing stock lending charges, and this process of selling share today and buying in future, returning back to broker, is called short selling. Selling when you do not have a share is called short selling. Please write it down. Yes. So I hope you have understood what is short selling. Now these fundamentals we have just learned. Basically we have prepared the foundation to start the pricing of the forward contract. Okay. So even if you want to write down the example, you can write it down in this type of way. You can pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down. Yes. So we have learned the basics. Now you take a break, and in the next session we are going to start the pricing of forward contract, and for next 2 lectures I am going to interchangeably use forward contract and future contract, but because future contract also the pricing rules are same. Okay, so but do remember, currently we are just studying forward contract. Okay, then I am going to explain you the mechanism of future contract after the 2 lectures, and then the index future contract will come into pictures and many more things. So take a break, and in the next session we are going to discuss pricing of forward contract. So have a good day and thank you for this lecture.